Here is something that almost nobody talks about when they discuss investing in Japan. 90%. That is the share of Japan's primary energy supply that comes from abroad. 90%. And if you hold Japanese equities, Japanese REITs, or even just the yen itself, this number should keep you up at night. Let me walk you through why. So let us start with the raw facts. Japan is the world's fifth largest energy consumer, but it produces almost none of its own fossil fuels. It imports roughly 88 to 90% of its total primary energy supply, depending on which year you look at. That includes virtually all of its oil, about 97% of its natural gas, and almost all of its coal. After the Fukushima disaster in 2011, most of Japan's nuclear reactors were taken offline, and even now, only about a third have been restarted. Before Fukushima, nuclear provided around 30% of Japan's electricity. Today it is somewhere around 7 to 8%. The gap was filled almost entirely by imported liquefied natural gas and coal. Now here's where it gets interesting from an investment perspective. Japan's energy import bill is enormous. In fiscal year 2022, when global energy prices spiked after Russia invaded Ukraine, Japan's fossil fuel imports hit roughly 33 trillion yen. That is about 250 billion US dollars at the time. That single line item was a major driver of Japan's trade deficit, which in turn hammered the yen. The yen fell to 150 against the dollar, a level not seen in over 3 decades. If you were a foreign investor holding unhedged Japanese assets, you got crushed not because Japanese companies performed badly, but because the currency fell off a cliff due to energy costs. This is the part that most portfolio analysis misses entirely. When people evaluate Japan exposure, they look at corporate earnings, monetary policy, demographics. Fair enough, but they rarely model in what happens when energy prices spike. And for Japan, an energy shock is not just an inconvenience. It is a structural vulnerability that feeds directly into the trade balance, the currency, inflation, and ultimately corporate margins. Let me give you a concrete example. Japan imports about 90% of its crude oil from the Middle East. Saudi Arabia, the UAE, Kuwait, Qatar, that is where it comes from. The shipping route goes through the Strait of Hormuz, the Strait of Malacca, and then up to Japanese ports. Every single barrel has to travel thousands of miles through some of the most geopolitically sensitive waterways on the planet. Now think about what is happening in the Middle East right now. Tensions have been elevated for well over a year. There have been disruptions to Red Sea shipping from Houthi attacks. Iran remains a wild card. If the Strait of Hormuz were ever blocked or even partially disrupted, Japan would face an energy crisis within weeks. Not months, weeks. Japan's Strategic Petroleum Reserve holds about 140 days of net imports, which sounds like a lot until you realize that a prolonged disruption would trigger global panic buying, and Japan would be competing with every other import-dependent nation for available supply. And speaking of the SPR, there have been discussions at METI, that is Japan's Ministry of Economy, Trade and Industry, about whether to consider a coordinated release of strategic reserves if prices spike again. The fact that this is even being discussed tells you something about the level of concern behind the scenes. Japan has participated in coordinated SPR releases before, most recently during the 2022 energy crisis. But each release draws down the buffer, and rebuilding reserves at high prices is expensive. So what does this mean for your portfolio? Let me break it down into a few scenarios. Scenario 1. Status quo. Energy prices stay relatively stable, shipping lanes stay open. In this case, Japan's energy dependency is a background risk, but not an active problem. Japanese equities can